my name is Lauri Anne. I'm a student in accounting at the Cégep Garneau. So today I'm going to talk about two main financial statements that reflect business activities based on revenues and expenses, the income statement and the balance sheet.
So let's start with the balance sheet. This financial statement shows the company's assets, liabilities, and shareholder equity in a specific point in time. In fact, the balance sheet is based on the basic accounting equation, which is asset equal liabilities plus shareholder equity. The first part of the equation, which is asset, is found on the left part of the balance sheet. Assets are listed in order of liquidity. The assets shows to the company what they owns. Then, on the right side of the balance sheet, you find the second part of the equation, which is liabilities plus shareholder equity. Liabilities are divided in two main parts: short-term liabilities, which appears in first, and long-term liabilities in second. This part shows to the company what they owe to creditor. Then, you have the shareholders' equity, who shows the amount invested by the shareholders. The most important thing to understand about a balance sheet is that it has to balance. The left part, asset, should equal the right part, liabilities plus shareholder equities. With all these informations, the investors can determine the value of the company. Now, let's focus on the income statement. It shows company's financial performance over a specific accounting period. There are five main parts in the income statement. First, you have the revenues of the company, who illustrate the sales of this company. For example, revenues of a shoes company would be the profit they made from sales of shoes. Then, you have to withdraw the cost of goods sold, which will determine the gross profit. If we take the previous example, the cost of goods sold would be the cost for the company to produce all the shoes they have sold. Next, you have to list all expenses of the company that are deducted from the gross profit to reveal the net income.
I hope this video helped you to understand the difference between the balance sheet and the income statement. So if we summarize, in the balance sheet you find information about assets, liabilities, and owner's equity. It is a state of finances at a snapshot in time. In the income statement, you find information about sales, cost of goods sold, and expenses. It helps to analyze the finance over a particular period. So thank you for watching my video.